Thank you for joining us for our Seaspray Making Waves podcast series, brought to you by Seaspray Financial Services Limited and Seaspray Private Limited. Seaspray Financial Services Limited, trading as Seaspray Mortgages, and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. This is Seaspray Making Waves podcast.
Hello and welcome back to the Seaspray Making Waves podcast series. This is episode 2. And you can catch the series in full on Spotify, Apple and YouTube and on our websites, of course. I'm delighted to say that joining us today are the two familiar faces from our first podcast, Paul McGowan on Seaspray Financial and Danny O'Leary, Seaspray Private.
Morning, Marty.
Great to have you back, guys.
Great to be here. Yep.
On our first podcast, we took a look at 2023 and the outlook for the year. Today, if it's okay by you, I'd like us to concentrate on the first quarter. We'll drill into that somewhat. And what a quarter that's been for financial markets. There's no doubt there's been some shocks to the financial system. And it's been a challenging investment climate. But Danny, I'm sure you would agree there are still some positives and green shoots for investors in there.
Oh, totally. Absolutely. I'm going to stop there, Marty, because I just want to say two things before we go into the quarter. Sure. It's been a very, very challenging quarter. And a lot of client conversations worried about banking crisis, etc. And I know we'll deal on that, shortly. But I just want to highlight two milestones which I think are very important as we're speaking today at the beginning of April. 25 years ago, there was the Good Friday Agreement. And to me, that it was such an important milestone when we're talking about financial markets and everything. But from a cost and from a moving forward, I think that was tremendous. And something I'm going to talk about later, if you let me, is 50 years ago this week. I'm not too sure if you were around at that stage, Marty, but there was a new prototype developed called the Brick. Paul, I don't know if you remember this. This was the first mobile phone developed by Motorola. I'm not too sure if Motorola is still around, but I can tell you that mobile phone and everything you and I are working off is there. The development in technology is massive. And maybe later on I can highlight from the original Brick to where we're going in terms of the next few years. In terms of that. I just wanted to highlight the two sort of milestones before we get into the quarter. In terms of the way. You're absolutely right. It's been a challenging quarter. But I just want to bring you back again to 2020, the 11th of March, 2020, pandemic. 26th of February last year, invasion by Russia in terms of Ukraine. And I think it's a case of beware the Ides of March again, because what we've had a banking crisis of its nature. And again, it's worrying times for investors. But the one thing I will say is that the stock market is a mechanism for transferring money from the impatient to the patient. It's very important to remember that you have to take the longer-term view and the longer-term horizon. And the do-nothing approach, sitting tight, is so important in the times that we've gone through in terms of this quarter one, Marty.
Yeah.
In all that's happened in terms of quarter one, and I'll, in a couple of minutes, just go through that, markets are up. We have the S&P 500 up about 5%. We have the European markets, the Euro stocks up about 12%. And in general, we're looking at the fact that despite all the volatility that's been there, sitting tight and doing nothing. So your typical balanced managed fund, for example, with bonds and equities, is up around about 1% to 2% in this quarter. And I think it's very much to take a stock in terms of the fact that a lot has happened, but also time will ease that out and we will get the results over the medium to long term for clients. So January, back to where we were and looking at it, January was a flying start. I mean, markets were up over 8% in America, 13% in Europe, Paul, and we thought we were moving ahead. We had stated in our outlook that it would be the second half of the year before equities would move on. Suddenly we had this spurt at the start and we had bonds moving in the right direction. And it was really risk on very, very much in January. It came to a shuddering end in terms of February when we had the double-edged sword. the central bank focus is on price stability, and it's on making sure that inflation comes back to the low levels.
Right.
And you had that sort of double-edged sword, markets moving ahead and the central bank saying, no, we're going to be more hawkish, we're going to raise interest rates. So markets pulled back. And then in March, we did have that banking crisis, particularly with Silicon Valley Bank starting that, and we'll probably go through that in a minute. But this is not 2008. This is totally different, and we'll hopefully highlight that in terms of the next few minutes. So all in all, an eventful first quarter. We've got a few green ticks. If I was at school, from the teacher's point of view, we have a few green ticks in terms of where we said rates would be, where we were looking at in terms of inflation. And I think we can be satisfied that the scorecard so far is probably reasonable in terms of where we were in looking at the outlook.
Absolutely, because we're going to see some of the issues and topics that we raised in the outlook.
Absolutely.
They will rear their head again this morning.
Yeah. So all in all, a very challenging and eventful and volatile. But Marty, again, I keep coming back. It's in those times that you see opportunity. And in all of the volatile sort of situations we've seen during January, February and March, that does allow us to look at new solutions, new opportunities. And I think we've done that during the year. And again, we'll hopefully highlight that later on during the conversation.
Great. Fantastic. You did make reference to the banking crisis, Danny, and Paul, if I can ask you, we all remember 2008, and unfortunately that's where our minds were brought back to when the SVP episode happened. Do you think there's any reason for investors to be spooked with what has happened with the SVB and Credit Suisse?
Well, I like in any situation where there is a negative move on banks, there is concern.
Yeah.
And that's where immediately the 6 central banks moved quickly to guarantee deposits as much as they could. Also to provide reassurance and to open a tap effectively for banks so that they could, shore up their balance sheets in the event there was going to be a run on a bank.
Yeah.
The big fear is contagion, as happened in 2008. And this time it looks like they have been able to stave off that situation. They've effectively ring-fenced a certain number of the banks that started to go under. So SVB, Signature Bank, and First Republic have all been sort of ring-fenced. The situation with Credit Suisse was different. And it just happened that it happened at the same time. It came to a head at the same time. But where things are, though, at the moment is that in 2008, there was very high levels of credit in the market. Household debt was extremely high, so consumers were under a lot of pressure. It's very different this time round. The consumer debt is much lower than it was previously. In fact, it's at levels that we haven't seen for years. And what this has meant is that very quickly, the markets have been able to sort of see through what's happened on the banks. When you look at it from an Irish point of view, and European banks generally, excluding the Credit Suisse situation for a moment, most European banks have tier 1, tier 2 capital substantially higher than they would have had in 2008. In many cases, more than double. So the ECB rules that they brought in have helped ensure you have a really strong banking capital. And this helps to kind of alleviate the concerns. We did see all the banks sector got nervous, but the share prices came off a little bit and have now stabilized and are actually coming back up a bit. The specific situation with Credit Suisse, that is a specific problem that had been going on for nearly 2 to 3 years. There had been a range of issues that had blown up with the management, and there were suggestions of involvement in the sort of areas of business that banks shouldn't really be entering into.
Right.
And in the end, that just came to a head in March around the same time. And the Swiss National Bank stepped in and got UBS to take them over. And they've now created the merged group with its asset base is actually an extremely strong business.
Yep.
So that issue has been taken off the table.
Right.
And I think at just looking over the weekend and into this week, you can see the banks are all opening up stable, and there's that whole area of fright actually seems to have moved back into the background.
Yeah, and I think it's a misnomer to use the word bailout in this occasion.
Correct.
It's more of an acquisition, really.
Correct.
In this instance,
Correct.
And I think the the regulatory authorities, they've come out quite confidently and said they have the tools to tackle any liquidity issues, haven't they?
I think, I just agree totally with Paul there. I think this is this is stock specific. Silicon Valley Bank was very much focused on the tech startup area, accumulated a lot of deposits over the last while. Totally different to what I call the subprime and the credit crunch that we had back then. This bank invested in guaranteed government bonds, 10-year, longer-term bond. But with interest rates rising rapidly over the last 12 months, Marty, what happened was you had a situation where the prices, when interest rates rise, bond prices come down. When they went to go and look to get money back from those guaranteed investments, they lost money, and that caused a bank run, which was very specific to Silicon Valley Bank, and spread to another.
But it's important to know, Danny, if they'd been able to hold the bonds to maturity,
absolutely,
there would have been no capital loss. The issue was that deposits started to pull out. And the reason deposits pulled out was that because the rise in interest rates in the States so rapidly, startup companies, which were the clients of SVB Bank, they started to need to pull down their deposits that they had received to try for their business. And as they pulled down the deposit, the bank needed to liquidate urgently some of its assets. And unfortunately, it had short-term deposits and it had long-term investments, which were in government bonds. And so that mismatch is what caused the problem. But that has been shored up now because the deposits were effectively guaranteed by the US government, and the whole situation has stabilized.
You really had bad management in both Credit Suisse and the Silicon Valley. And I do believe the regulators are now looking at those, what I call the regional banks in America, because most of the top line banks, the regulatory requirements in terms of capital, et cetera, are far more stringent. And in Europe, it's been very, very strong since the crash. I look back to last week's comments by one of the Fed, the Boston president, Susan Collins. And there's a lot in that comment that she made. She's saying that there is now very much a situation whereby there is under control and tight controls in terms of both the liquidity side of things from the central bank and also tight control in terms of where they want to see inflation. So there are tools for both.
Yes.
And I think she communicated this in, as far as I can see, very, very well. So what happened was you've had a situation where you've had a crisis, but the swift action from the Fed, from the FDIC, et cetera, and from a European perspective as well, I think that swift response was needed. But while we're tightening on the one hand from the central bank, they were able to loosen and have the liquidity available to make sure that liquidity as required was available in terms of the banking sector. So I do believe they got it right, and I do believe it's restored confidence in a fragile banking sector at that time.
But from what you're describing there, it's a totally different scenario, really, to 2008. So which is good news all around. Obviously the banking crisis then hit this little country quite hard, but I think, was it Enda Kenny? I think Enda Kenny in 2016 said that he wanted to make Ireland the best little small country in the world to do business. So I think we're making some strides towards that at the moment, and the Irish economy in recent times has performed particularly well, and we're demonstrating a certain resilience to the turbulence out there. So, Paul, if I can ask you, what do you think that can be attributed to?
Well, I think firstly the thing is to look at the numbers, and we have the largest number of people ever in the history of the state employed. So they're generating tax receipts, which is really good for the state. We still have a young European population, highly productive. The productivity rate of people in Ireland is substantially higher than anywhere else in Europe. So you're getting really good performance from companies, and at the same time, you have a huge employment level relative. If you look at it, there was concerns at the back end of last year that the economy this year might only grow. Forget at the total GDP. If we look at it on a modified demand basis, which is excluding the international companies, there was concerns we were down at about 1% sort of thing. The central bank has now come out and upgraded their numbers for this year. They're suggesting that the modified domestic demand is going to come in about 3.1%. And again, just under 3% for next year. So there are not many countries in Europe who would be coming anywhere near that. In fact, there's nobody. We're the highest growth rate in Europe.
Right.
And in fact, our numbers lifted the European numbers out of going into recession and have allowed for an adjustment in Europe so that the fears of recession have receded to some extent, particularly in the first half of this year. The combination of then you add in, then we do still have the international corporations here in the IT sector, in the pharmaceutical sector, which is the biggest sector at this point in time, and in the software areas. So those combine, and they have actually outperformed again. And what that does then is it's generating these supernormal corporation tax profits, which are going to increase further as we bring in this 15% tax rate, which is due to come on stream. And the markets will be watching for that very carefully. There are some issues around that with regard to Pillar 1 versus Pillar 2, but which I don't think we'll get into here. We'll get into it another time.
Yeah.
But there are question marks around how it's going to operate. But at this point in time, it looks like we're going to see an increase in our corporation tax just based on that. Now, some of that will be ameliorated by the fact that it is a slightly slower growth than we'd had maybe last year, the year before. But it's still a very strong performance overall for the Irish economy. And, we're looking at a situation now where we're effectively at full employment. So 500,000 more people employed in the state than ever before. And yet we're now at full employment. So we're still, if you could go down any high street and you'll see workers required. Every job is looking for people. That's right. And every company is looking for people. So that is a big demand, and that is drawing in further immigration back into the country, which is good for the state. The issue against that then is the whole housing issue, which I think everybody is aware of.
Yeah, that's the elephant in the room, isn't it, really?
Absolutely.
Yeah.
Even with the creation of 27,000, even if they hit that number this year, it's still, the supply and demand factors are still going to be out of sync. I think you're probably going to see flat property prices, I think, this year, Paul, in terms of there's not going to be a dramatic downturn in that, and that's simply down to the supply and demand factors that are...
Yeah, like the increase in interest rates does definitely affect the ability of people to pay up and buy. So that's a pull factor that pulls down pricing. But the strong demand is helping to support. So you've got this supply-demand issue going on the whole time.
Yeah.
On the commercial property side, I think you are seeing a slowdown in terms of transactions that are happening in the first quarter. And I think that's a reflection of a bit of credit tightening, which is happening now out there. And I think with yields on, bonds at 3%, 4%, 5%, et cetera, you're going to see a slowdown in those transactions for the first half of this year. But I think as we get to that peak level in terms of interest rates, I think the market will pick up towards the last 6 months of the year.
Yeah, well, certainly for FDI, they're going to have to get the housing situation sorted quite quickly. I thought you were going to say that it was down to the fact that we're the number one rugby team in the world and we're beating everybody all around us, but no.
we'll take that as well. It was brilliant.
For sure.
Absolutely, Marty.
For sure. Yeah, so despite the volatility, Danny, that has been evident, obviously, for the past while, there's a strong argument for, as you've mentioned, for long-term investment planning, which is diverse and which really backs particular investment themes. So, what's the thinking? And I know you have some professional experience of that yourself. What's the thinking behind a more structured approach for investors?
I think it's, I suppose, important to point out that in a well-diversified portfolio, most clients and most investors got caught last year because you had this direct correlation of bonds and equities moving in a downward direction. And it hurt a lot of investors in what we would call the multi-asset type portfolios, because bonds normally are a defense, and you didn't see that last year. And I think that hurt. We've had a pretty strong start in terms of the bond particular element of that. I think that's going to continue over the next 6, 9, 12 months as well. I think it'll support the multi-asset side. And I do believe, equity performance will be risk on, as we move through the year. I think from an opportunity perspective and some themes, just to let, in this last 3 or 4 weeks, 2 years ago, we created a green defensive structured solution. It had a 9% coupon. So the first anniversary was after 2 years, and it came right in the middle of the banking crisis. But it kicked out, and our clients got 18%. Now, those are the type of scenarios that if you can look at the medium to long term, you can see the benefits of part of the portfolio between equities, between bonds, between some property and structured solutions. And I do believe that for clients who can look at the medium to long term, there are opportunities to actually add value to the portfolio in good times and in bad times. So I think in terms of the green and the ESG focus, that was a really strong vindication that over the last 2 years, it not alone was doing the right thing in terms of sustainable investing, it was doing the right thing in getting return for clients as part of their portfolio. Other areas that we've done and looked at in Q1 was, going back to my theme back in January, it was the technology. We are very strong, coming back to my brick and my Motorola's and whatever. We believe technology, it got hit last year. And, as interest rates rising, et cetera, markets were back double digits. And we're now seeing, a move in the right direction, I think, and technology is not going away. So we again priced a global technology solution with a 14% coupon. And that's over the next 18 months. And again, we believe that is another theme that we should be looking at in terms of a go forward. Alongside of that, as a result of the maturity of the Green Defensive, we have a transatlantic green ESG solution. And again, that's a 10.8% coupon, again, over the next medium to long term as part of portfolio construction. But it's pricing in volatility that allows us to get that value for our clients. The very last one that I would like to point, I'm a dinosaur in terms of all of this, but metaverse, for people who are not familiar, is really going to take hold in the next decade. The spend is probably about 120 billion this year. It will be in the trillions when we get to the end of the decade. So the next generation coming through are going to be dealing with virtual reality, augmented reality, smartphones. But the companies that are doing that now are the top companies across the globe. Microsoft's, NVIDIA's, Amazon's, Walt Disney. These are the type of companies that are involved at the early stages in terms of the development of this. And we believe that's an opportunity. And we have a global innovation structure solution with a 12% coupon that we believe will capture that theme as we go forward.
Okay, so
I hope that gives a flavour.
It does. It definitely does. It goes back to your Warren Buffett quote earlier on.
Totally.
It reinforces that. So what you're saying is that we'll be three avatars in the future, will we? Yeah.
Exactly. We'll have to get the headsets on.
We won't even be here.
We won't even be here. Yeah, exactly. Yeah. Well, there's no doubt from what you're saying, generally, that the regulatory authorities and the policymakers, they'll be concentrating and their focus will be on core inflation, really globally. And I think that's a fair assessment. I mean, the monetary policy won't really change from where it has been for the last while.
I think price stability for the next, it's on the agenda. The one thing that's happened with the banking crisis, and again, we've looked at this over the last couple of weeks, the banking crisis of its own is going to create that tightening.
Yep.
So it's actually going to help, I believe, the Fed in terms of where they eventually see interest rates moving. And from a European perspective, I think we called it in January that 5% would be around the sort of top end in terms of the Fed, and probably maybe 3.5 around from the ECB. I think we're on target that, combined with the banking situation and the tightening there, and where the Fed are now looking at, I think there's probably a couple of 0.25 rises in terms of May, June. And I think the ECB likewise, Philip Lane came out there in the last week or two to say they still need to get there. So price stability is going to be the focus. They want to get that inflation down. And I think the one word we're looking at the moment, Marty, is sticky inflation.
Yeah. Yeah. And I think the issue is that there are still uncertainties. And like we saw it over the current weekend, OPEC Plus has decided to cut production, which is going to force the oil price up a little bit. Now, it looks like the Saudis want oil above $80, and it is in or around that at the moment. It hasn't rushed ahead, but it has definitely just made everybody sit up a little bit and go, okay, hold on a second here. We're not going to have oil price back down to $40 a barrel or $30 a barrel. So that will, quarter on quarter, then if it stays at that level, then the inflationary part of that impact disappears. But if it started to go back up, then you start having it feed back into inflation. So I think, and we've in our note for the quarter, we've talked about this and about how inflation is still, there's an uncertainty around it, but that the central banks are very focused on trying to get it down, and that if everything else stays still, it will start to continue to fall. We are seeing it in the last 2 and 3 weeks. Any numbers coming in are coming in slightly better than the previous quarter. But it's a slow process. The fact that core inflation is staying so high is an issue for the longer term. And we have to remember their target is somewhere around 2%. And when it's sitting above 5.5%, well, then that's an indication quarter on quarter that it's too high and that there's going to be issues. If you look forward through the sort of projections on interest rates, as Danny has just said there's probably 2 interest rate increases still to come, maybe a third, we're not sure. But at the moment, the projections are now showing that for the second half of the year, they'll have topped out, and that by the last quarter, we should start to see some interest rates actually falling. And history has shown that once interest rates have peaked out, the actual speed with which they start to turn down can surprise people. You can have within 3 months, you can have the start of a move backwards, back down again. And therefore, we know we're close to the top on it, but not quite there yet.
Yeah. Well, I think there's also what's happening in Asia. I suppose will have an influence with the Chinese reopening. This
is something that I'm beating the drum. I think the market is underestimating China, and I know hard sometimes to believe the numbers, but when I looked at the recent manufacturing at 58, PMI, and it's not their exports that are driving this, it's the domestic the Chinese economy itself is opening up after a couple of years. And purely on a domestic and consumer consumption, it's moving. And I just believe from a European perspective in particular, I think that is a positive for us. And I think our view would be that developed markets are still going to be very much, 1 or 2% in terms of growth. I see China coming in at a 5% growth rate this year. And from an emerging market scenario, I think that will benefit, international trade as well. And I think Europe will be a beneficiary on that. Valuations are not expensive from a European or emerging markets.
Yep.
There may be still a little bit there in terms of the US equities, but again, the last 12 months they've re-rated as well. So we do see long term that there is valuations that are that could give us decent returns over the next 3, 4, or 5 years. And as Paul highlighted, I think we're probably of the view that interest rates peaking as we had at the very start of our year and a green tick, that they sort of peak around mid-year. And I think I'm probably in the camp that it'll still be early 2024. I think the central banks will want to see core inflation really coming down. But even if it's early 2024, Marty, I think that's a strong signal. Markets move ahead. And that's a strong signal in the last quarter for markets to move in the right direction in terms of adding value back. It's back to investors and back to their portfolios. It has been a struggle. But the critical thing here is that be patient.
We're long-term investors.
We're long-term investors.
Yeah.
There you go.
Yeah, there you go.
Works in tandem.
I hear an echo. Some terrific insight there, guys. Absolutely. That's been terrific. Yep. As is customary with the podcast series, we like to ask clients to submit some questions. So I have a couple, if you don't mind. Paul,
I'll pass them to Paul.
I'll address the first one to you, Paul, if that's okay. One client is asking, is there any risk of contagion to Irish banks after the Silicon Valley Bank and Credit Suisse issues?
Well, I think we've kind of answered that question already, but I don't believe there is. Our banks are extremely well capitalized, and we're in a situation where the lending has increased, which is good. They're moving back into profitability, but there's still a long way to go in that sense. And the deposits are at an all-time high with banks at the moment, which is amazing against the backdrop, as we said at the previous podcast, where we talked about the fact that consumer spending had picked up. But the Irish market is, investors are really ensuring they're keeping money on deposit at the same time as they're opening up their purses. So it's a lovely balance. And you have a situation, obviously, where corporate profits have been very strong. So that helps boost funds on deposit as well. So I don't believe there's a contagion effect here.
Right.
And I don't think the Irish banks are going to suffer. Now, they did react. Like at the beginning of the year, you saw the share prices. Bank of Ireland was trading around 9.22 and AIB was around 2.70. When in February, when we had this really good run in the markets and Bank of Ireland came out with good numbers, they got up to 10.78. They are now back around 9.36 again. So you've had a little bit of a spike in the share price and it's come back down a bit. But it's, and we would be happy buying in around these levels. In fact, we would use this as a good entry level now at the moment. Because the overall backdrop for the earnings of those banks is very strong. And remember, when interest rates go up, bank margins increase. And so they start to make supernormal profits. So that will feed in. And we would have both Irish banks on our buy list if you're buying Irish equities.
Okay, that's clear. Thank you. That's great.
I think another critical point is debt levels back in 2008. It was a credit crisis. You know, that the amount of debt and household debt has dramatically decreased in terms of that time. So I'd be with Paul 100% that it's the Irish banking situation is sound in terms of where we are.
Nothing to see here. Move on. Danny, for yourself, here's a question which I think will be of interest to you. For a long-term investor who doesn't need immediate access to their money, is it better to sit in a high-risk fund that aims to return double-digit growth, or would it be better to employ a rolling portfolio of structured products?
Very good one. I'm of the view that if you can't stand the heat in the kitchen, i.e. high risk, you don't go there day one. It's all about balance. And for some clients, some in a sort of a high risk, if you can look at the next 15, 20 years, yes, they will have delivered. But again, you're going to have challenging times where you see a lot of roller coaster scenarios in terms of that. I think the critical thing in terms of when I'm constructing portfolios for clients is that you have a core, if you like, which is a balance, which is diversified and well diversified. And then you use satellites, and you can use a high risk and energy, renewables, whatever, water fund or whatever, as part of your satellite to add that value in terms of the overall. But it doesn't necessarily mean you have to have high risk as your total portfolio. Right. So yes and no in that sense. I think you can actually construct portfolios that you can actually have a combination. And it's through that combination that you can get the benefits of potentially double-digit return. I keep coming back to it, the rule of 72. You only need 7% per annum over a 10-year period to double money. This is very important. You don't need to be taking extra risk in terms of your portfolio construction to achieve decent gains over the medium to long term.
Great.
Yeah, and also, Marty, to answer that question, the first thing is you need to really know what the client's attitude to risk is.
Absolutely.
So
yes.
We, as a house, put a lot of effort into looking at defining the client's attitude to risk. And only when you have that can you start the construction of the portfolio that they want in the fashion that Danny has just described.
Very good point. Absolutely.
Very important. Very important.
So that's flown along, guys. It's a terrific bit of insight again, and can I thank you both for helping us make waves again today in our second episode.
Thanks a million.
And for our viewers and listeners who want to read more about the Seaspray House view, I'd like to refer them to our Q1 investment update, which is currently available on our websites, on our LinkedIn pages. This episode of the Making Waves series is available on Spotify, Apple, and YouTube. And you can catch us on the website, of course. So thank you all, and thank you for listening, and we'll see you next time. Bye for now.
Thanks, Marty.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you. Seaspray Private Limited, trading as Seaspray Private, is regulated by the Central Bank of Ireland. Seaspray Financial Services Limited, trading as Seaspray Mortgages, is regulated by the Central Bank of Ireland. Thank you.